Tailored Brands, which owns Men's Warehouse and Joss A. Bank, is closing hundreds of stores and drastically reducing its corporate workforce as the coronavirus pandemic continues to decimate retail. The company has identified 500 stores for closures and is cutting 1 in 5 jobs. It hopes to strengthen its financial position to enable it to compete more effectively in the challenging retail environment, according to a press release. Is this really the company that Burry went all in on by buying millions of shares and by attempting to redirect its operations to boost its performance and share price? Yes, it is.
We have no confidence in your ability to identify macroeconomic trends.
Despite the fact that Scion Capital's most recent SEC filing indicates that Burry had 1.7 million shares of Tailored Brands as recently as March the 31st, his position, being less than 5%, can be sold quietly without further notification to the public. Dumping stocks when they approach 52-week lows is one of Scion's go-to strategies. Therefore, it is far from obvious that Burry is still invested. In this video, we look again at Burry's fundamental analysis of Tailored Brands. Does Mr. Mike Burry think it's reasonable not to factor in curtailed trading due to COVID?
Dr. Mike Burry, yes he does. That's cute.
Predicting this many store closures would first have required predicting a lockdown and government mandates which have no precedent in 6,000 years of recorded history. We will look at what the store closures mean for Tailored Brands, whether a consensus downward revision of the stock price to just $2 is justified, and what impact newly appointed Chief Restructuring Officer Holly Etlin will have on the turnaround prospects of the company. Coming up today on Finance in 5. Unfortunately, due to COVID-19's pandemic and its significant impact on our business, further actions are needed to help us strengthen our financial position so we can navigate our current realities, said Tailored Brands CEO Dinesh Lathi. The store closures and resulting layoffs will cost the company $6 million in severance payments and other termination costs, Tailored Brands said. The stores will close over time, and it has not yet quantified the expense savings and costs related to potential store closures. 10% of that money, or $600,000, will go to departing Executive Vice President, Chief Financial Officer and Treasurer Jack P. Calandra, aged 51, who has worked at Tailored Brands since 2016. Here we see Calandra's total compensation in 2019 exceeded $1.1 million. This might sound like a lot, but in the previous year he earned $2.5 million. Maybe he grew tired of these pay cuts and just thought, fine, Tailored Brands, you can keep your off-the-peg suits. I'm out of here. But in the top echelons of any high-profile company, paying a premium to retain talent is a necessary step. These roles require high levels of responsibility and long working hours and are not for the faint-hearted. At the same time, Calandra's exit will save the company money and enable it to focus on restructuring. Tailored Brands was reportedly nearing bankruptcy and talking with advisors for the past few months. Whether or not you believe CNN is up to you, but one analyst previously told CNN Business that the odds of it filing for bankruptcy eventually were pretty high because of reduced demand for dressier clothes.
Each year, which is high, but I was the first to do this trade.
Many working from home employees have opted for more relaxed looks of t-shirts and sweatpants rather than pinstripe suits and custom shirts, the source said. It is true, and there is something fascinating about the psychology of that actually being admitted openly by somebody. It's an acknowledgement of the fact that if we didn't have to see other people and at least attempt to present some kind of veneer of respectability, many of us happily would wear the same clothes endlessly month after month, lurching irresistibly towards squalor, a strategy which perhaps Burry adopted long before lockdown, according to legend. Anyway, back to topic. Although most of its stores have reopened, sales have been declining. For the week ended June the 5th, sales at locations open for at least 1 week fell 65% at Men's Warehouse. They were down 78% at Joss A. Bank and 40% at K&G. Sales declined 60% in its first fiscal quarter, which ended on May the 2nd. All of its stores were closed for about half the quarter, and its online operations halted for 2 weeks in March. Tailored Brands is the second menswear company in July to hit trouble. Earlier, Brooks Brothers filed for bankruptcy, citing the pandemic and men giving up dressy clothes. Global Data Retail said in a recent note that year-over-year sales of men's formal clothing fell by 74% between April and June. Brooks Brothers, of course, famously supplied Abraham Lincoln's suit, in which he was assassinated in 1865, and was JFK's clothier of choice. And with a logo that appears to feature some kind of slain farmyard animal, it's not a stretch to imagine that a brand so closely associated with death would sooner or later meet its own demise. But anyway, back to Tailored Brands. If the lockdown had only lasted for a short period of time, say 1 or 2 months, the situation would be much less dire. But the longer that it goes on for, the worse the effects on Tailored Brands. While this deterioration will ease over time, demand will remain suppressed for the rest of 2020 and well into 2021 as office working, business meetings and socializing are all reduced, the firm said. The headquarters of Tailored Brands is based in Houston, which has had its own struggles with coronavirus, although news reports suggest that a recent surge in cases has begun to stabilize. Not that you'd believe it by visiting HoustonFightsCovid.com, a website which openly advocates mass vaccination, quoting a certain imbecilic Italian who talks of stars aligning and cards falling, closely modeling the communication style of a retard. A number of investor message boards I've been reading show a fairly even split of opinion between those who think that the restructuring is a good idea and a robust attempt to turn the company around, and those who see it as an obvious precursor to the company filing for bankruptcy in coming weeks or months. A lot of people make decent points on this board. How many weddings have you been invited to this year? Asks one. Which is a fair question until you realise that some people are so unpopular that they never get invited to weddings regardless of the state of the economy. But yes, weddings have been put back to 2021, and few can deny that the more weddings there are in America, the more customers Tailored Brands, Men's Warehouse and Joss A. Bank can sell or lease items to. More pressingly than that, Tailored Brands has skipped a payment for its July notes and needs to get that done quickly to avoid interest charges or delinquency. One contributor points out that liquidity has dropped since the 2nd of May, while bills are still due and salaries need to be paid.
My God, Mike.
Which is correct, but Tailored Brands has furloughed some of its staff, which means Uncle Sam will be meeting those furlough payment obligations as opposed to Tailored Brands itself, so it shouldn't be a drain on their bottom line. It would be useful to know how many staff continue to work there as a proportion of the overall workforce. We know they're scrapping 20% of workers, but how many are on furlough and how many are working in the stores? And what other cost-cutting measures have they implemented? Reopening the e-commerce digital fulfillment centers will enable the company to serve customers even in the absence of physical stores. There's an argument that if they get this right, for instance by optimizing their sales platforms to give virtual representations of items before people buy, by rewarding loyal customers with discounts, by offering free next-day delivery, then their online sales can outperform those of their physical stores, which will make shedding a third of the physical stores and all the associated rent and other costs look like a smart move. I talked in a previous video about how the transition from retail stores to selling online is similar to the adaptation from agriculture to industry back in the 1930s, and those companies that can adapt to this new reality will survive. So the question becomes, will they adapt?
Holy shit! Oh, motherfucker!
Michael, give me my money back. Michael, do you hear me? I want my money back. Give me my fucking money back. You motherfucker.
As for Holly Etlin, who was appointed recently as Chief Restructuring Officer answerable directly to CEO Lathy, she seems to have a history of bringing back companies from the brink and is unafraid to make tough decisions when it comes to ditching what isn't working in a business, whether that means firing unproductive team members or upending complacent approaches which hinder sales. She won't hesitate to trim the fat where needed.
What are the mistakes that you've seen that they've made that others can learn from? Well, the problem with retail is we're really a victim of our own success with regard to how we finance those businesses. The businesses are financed very, very close to liquidation value of the underlying assets. And so where the management team needs to look and see, or can see in most cases, the fact that they need to change, their customer has evolved, new competitors have come into the environment, etc. The fact that they still have liquidity much longer than, let's say, an automotive manufacturer or some other kind of chemical business or an oil and gas business, because that lending exists for them and that liquidity lifeline exists for them, they unfortunately go too far out on the skinny branches before figuring out that they really need to make urgent change quickly. And then, of course, find that they don't have enough of a runway liquidity-wise to actually implement that change, because closing stores is expensive. Remerchandising is expensive. Getting rid of lines of business is expensive. And you have to really look much earlier in the process to what it's going to realistically take you to do in order to get there. And that was the case of, Borders. That's been the case of a lot of other retailers who are no longer with us.
And you certainly, in your profession, have to have long-term vision, especially when it comes to technology. What's going on in technology today is going to be completely different than what's going on in technology a year from now or longer. So do you meet resistance from some of these corporations that have been around forever and they're really not on board with the technology? How do you deal with that?
So every group of people within a business which has been successful historically, they like to remember their successes. And it's very hard for them to internalize the fact that they're now not successful and make those adjustments. It requires leadership. It requires more decisive decision making than they're used to doing. And that's a real problem. On the other hand, because I work mainly in distress, the fact that the brick wall of running out of liquidity is looming ahead of you closer and closer and closer causes you to be willing to then make those changes much more quickly. Changes in technology are no different than, frankly, changes in consumer behavior or changes within the competitive landscape in your industry. They're all things that require the company to make structural change. And if they don't make it quickly enough, they're no longer going to be with us.
One of the key reasons why Tailored Brands is in this mess in the first place, in my humble opinion, is because of the spectacularly awesome nightmare that took place in June 2014 when Men's Warehouse bought Joss A. Bank for $1.8 billion. The resulting company was called Tailored Brands, and these smaller retailers, including K&G, remained under its umbrella. Just over a year after this deal closed, it was determined to be worth a mere $550 million. So, who would be responsible for such a catastrophic and absurd takeover, which immediately put the company on notice of bankruptcy risk? None other than Doug Hewitt, a bearded baby boomer who, in return for bankrupting everything, was rewarded with millions in salary and bonuses. Very much the modus operandi for the baby boomer generation. Take everything for yourself, act like a sociopath, and foist all responsibility and debt associated with your horrifying and despicable actions onto the people who come after you. The hell unleashed by the psychotic baby boomer generation defies contemplation. I'm thinking of doing a video about baby boomer politicians to illustrate this very point still further. And then when the world is burning and we're still feeling the aftershocks, they step in and expect to be paid for consultancy services, and they pose as the savior of the nightmare that they helped to inflict. And then they have 30 years of pensions to look forward to, paid for by you, paid for by a generation of increasingly depressed tax cattle and wage slaves who, if boomers had any respect for whatsoever, they would stop pillaging. Anyway, even Burry mentioned that it was regrettable that the merger took place and bad for shareholders. So the upshot of this analysis is that it appears that the company is at least attempting to restructure. It's cutting costs. Maybe Calandra left because he didn't like the direction CEO Lathy was taking the company in. The situation is very much in flux, and if it is possible to turn the company round by focusing on e-commerce, then that avenue will be pursued and could be a game changer. Maybe Burry is no longer invested. Maybe what they say is true and demand will at best be subdued until 2021 or longer. The reality is people are making fewer discretionary purchases due to jobs and incomes drying up. We need to wait and see what happens, and I'll do an update and drill more deeply into numbers and figures when more data is available. Thanks for watching. I know they're far from perfect, but I do try hard with these videos, so if you find value in them, and if you haven't already, then please like and subscribe. It would mean a lot. Thank you very much. All the very best.